Mm. All right. Oh, do it this way. There I can. Oops, I can see better. Yeah, I'm guessing everyone can hear me, given if Alistair can hear me.
Yes, we're
Yeah.
good. Thank you.
Yes, I can hear you.
Great.
Good.
So I was just going to start with the usual overview of a graph, and I'll re-explain it just so that everyone's on the same page. So the black line is the most important one. It's the 10-year minus the 2-year treasury. Sorry, minus the 3-month treasury, and that's an indicator of the inversion of the yield curve. And when the yield curve inverts, banks stop financing people because they don't make money, and that's when you usually have a few months later, a few months to a couple of years later, you get a credit crunch. So as you can see, we've had the yield curve that inverted a little while back after the pandemic, um, and that it's started to uninvert recently, but it's starting to reinvert again with the recent tariffs talk at the beginning of this year. The second line is the important line is the blue line. That's the credit assessment. It's the triple B, so it's the lowest investment grade corporate bond minus the 10-year treasury, and typically credit spreads. So that's what you call it, credit spread, the yield of the corporate bond minus the 10-year. And typically credit spreads tend to increase when you are in a credit crunch. So currently what you can see is that the credit spreads really aren't that affected by what's going on these days. And so there's doesn't point out that the inversion of the yield curve has caused any sort of turmoil in the credit markets, and currently people are still able to finance themselves. Um, I did want to point, I didn't want to bring in something because I was at an investment conference. Well, I'll bring it up a little bit later. Let me finish the graph. So then the red line is essentially a proxy for the equity markets in general. Fred has changed their equity market, so I used the Nasdaq before we used the Wilshire 5000. It's the same idea. It's basically the yield curve inverts a few months to a couple of years before the equity market tops, um, and we haven't really seen that happen yet here in this cycle. And I think that's it for there. Any questions on that? Please jump in. So that graph, I sort of zooming in and using a slightly different index, but still credit related. So here you get the 10-year minus the 3-month, the 10-year minus and then the Chicago financial conditions spread credit and sub index. So again, measuring basically the same thing, but as you zoom in, you can see that that yield curve inversion is starting over again. It peaked up a bit, but it's coming back down. And there's a very slight tightening of credit conditions. And that's probably mostly due to the sell-off in the equity markets at the beginning of this year. The one caveat I would put, because typically a credit crunch happens when, you've got a lack of financing or ability to refinance.
Liquidity. Yeah.
I've been at a few investment conferences over the past sort of 6 months to a year. 3 weeks ago, there was Alts LA, and I was hearing a lot of chatter around private credit, and people were using very similar terms in private credit as they were in RMBS and CMBS. So also those instruments that people used prior to the financial crisis for real estate. They're using very similar type of instruments these days, or financial vehicles in private credit markets. So the slight difference that we have versus the pre-financial crisis versus now is that a lot of the financing has gone outside the banking system and is not necessarily reported or regulated. So it's a little bit harder, I think, to get a read on what's going on, because before the banks, and typically the investment banks, used to do a lot of this financing. Now, a lot of that, because of regulation of the banks, has been pushed to private equity companies like Blackstone, Apollo, Ares, like those large corporates, and you've got fewer and you don't see them. They don't report all their funding and their financial instruments. So it might be a little bit harder to see what's going on. I was at an Oak Tree conference about 6 months ago, and Oak Tree had mentioned that they saw a debt wall coming into not a debt wall, but the refinancing that was needing to be increased over the course of 2025, and then really increasing in 2026. So just bearing those things in mind in terms of refinancing requirements. So the yield curve is reinverting again. There's a little bit tightening to do the sell-off. There's nothing crazy, nothing that would tell you that there's a recession is imminent, at least at this point. This is another measure on the left side, is another measure of financial conditions by Goldman Sachs. As you can see, it's tightened due to the recent sell-off here, but it's nothing that's really outside of the ordinary. Definitely, we're far away from, for example, the pandemic highs. On the right side, there's been a reassessment of the GDP impulse, mostly due to a lot of those tariff speaks by the Trump administration. So you see, in January 17th, the GDP was still probably going to be slightly negative, but because of what's recently happened, that GDP is being reassessed a lot more negative. So the tariffs, a lot of what's going on right now in the sell-off in the markets, I think, is really linked to the tariff talk. So I touched on sort of the overall levels, and then sort of very high level. Now I'm going to talk a little bit more about inflation, because the two mandates of the Fed are inflation and full employment. So on the inflation side, these are different measures of inflation, and I'll go through them. So the red one is basically CPI. It's the typical one that everyone looks at, Consumer Price Inflation Index. The green one is the PCE. It's core PCE, and that's the one that the Fed uses as its benchmark. So the Fed, when it says we're targeting 2% inflation, it said it's targeting this PCE, the green line. And since it's targeting 2%, it's still a little bit above, but that's probably not too worrisome for it. And then you've got the core CPI, which is the purple one, which is, again, above all the other ones. They're all sort of trending down. And then the last one is the 5-year, and I put that there because that's typically, if that thing starts trending highly upward, it's sort of a market-driven inflation expectation. And if that were to be trending upward, the Fed would start getting a little bit worried, and they would start probably hiking aggressively. As you can see, that's trailing off. So they're not too worried about sort of that 5-year forward, which is basically telling them that inflation expectations, at least from the market perspective, are not getting out of hand. So the Fed doesn't really need to ease right now, doesn't really need to hike too much. It's probably more in the hiking camp than it is in the easing camp at this point, given where the PCE is, so where that green line is. So it's slightly above 2%. I think it's around 2.8 right now, and it's trying to get it back down to 2. So more likely to hike than to ease, but not too pressed to do anything one way or the other, at least at this point. Here's again just another sort of other ways of tracking inflation, and this just puts a lot of it into perspective. There's just a lot of different measurements of inflation here. The biggest takeaway is that the core PC is the one that the Fed targets. That's at 2.79%. It's also that blue line here, again above target, but not crazy. It's sort of understood now that as long as it's not trending above 3, the Fed is not going to be under any pressure. They're not too worried, but they're still going to try to bring it back down to 2. I think that's all really to get off of this graph. So talking about the tariffs, this is the sort of the main sticky point in sort of recent history about what's going on in the markets. You've had these successive announcements of different tariffs. Mostly the first ones are the ones that were announced by the Trump administration, and then in retaliation, a lot of people have announced tariffs of their own, sort of a bilateral. Bear in mind, China puts a lot of tariffs on everyone regardless. So even if they're announcing reciprocal retaliation, they already have some. So what we're on the right side, what you can see is the evaluation of what that overall tariff is currently. And you can see that we had very, very low tariffs basically since the 1980s, at least the United States did. And there's a historical reason to this. And I guess I'll briefly mention it. So part of the reason that the US has very low tariffs is that post World War II, everyone's manufacturing base was basically dead on the planet, except for the United States. It's really the only country that didn't really have war a manufacturing country that didn't have wars on its own territory. Um, and so it basically said in order to try to, keep peace throughout the planet, we're going to open our borders to you, and we're not going to put any tariffs on you, but you can do whatever you want with us. So that's why the US really dropped all these tariffs sort of post World War II and tried to keep them low. Um, and in 2000 here, you sort of have another trend where China entered the WTI, and so those tariffs really were extremely low. So we have been in a period of extremely low tariffs that the United States has been imposed upon the rest of the planet, at least for accessing its market. So it's fairly low, and that's now been jumping. So that's also what people call globalization. This drove globalization, where the U.S. was exporting a lot of its production of goods to other countries. And part of what the Trump administration is trying to do is trying to say we need to repatriate jobs to the United States, possibly the manufacturing base. So we're gonna try to get good deals from other countries, and we're going to try to hike tariffs. There's another probably intention behind the Trump tariffs is to try to maybe potentially negotiate deals on a more bespoke basis. So hiking tariffs is a way to bring people to the negotiating table, and then maybe negotiate afterwards a broader trade agreement with these countries. And as you can see, we're basically going from an extremely low base that was sub 5% to a now current base that's around 18-ish%, and with the announced tariffs that are somewhere around 25%. So quite a substantial increase, and brings us back to essentially what the United States was before it had income tax. People probably don't remember, but before the United States had income tax, the United States didn't do income tax. The federal government didn't. It usually only financed itself through tariffs. And then they decided that they want to remove tariffs and switch to income tax as a main source of funding.
Can I interrupt and ask?
Sure, sure.
So I saw that they have that GS baseline. So I'm assuming I didn't see any. Oh, so here it is. So this chart is reference from Goldman Sachs?
Yes.
Okay, thank you.
So the main effect of tariffs, at least from the things that are important to the Fed, would be to increase the inflation expectations. So this is at least the projection of what the current assessment of Goldman would be in terms of what the inflation expectation on PC would go up to. So it'd go up to 3.5%. And so that's not very positive in terms of what it means for the Fed, because the Fed would then probably have to hike to try to get inflation back under control. And that would be basically hitting both GDP, because you would reduce exchanges, at least in the near term, and it would also be hitting the interest rates going up. So it would also hit GDP again by hiking interest rates. So you'd have an inflation increase. Well, you'd have tariffs that would reduce trade, and then you also had the Fed potentially hiking to reduce inflation that would probably hit GDP as well. So it could potentially be a double whammy, and that's what's scaring, I think, a lot of the markets these days. So as this is the assessment, now this is what the inflation expectations look like, and the only one that's really reacted so far is the Michigan index. So there's a survey that the University of Michigan conducts, and they ask about people's inflation expectations, and so that one, the March preliminary reports of the past month, basically just jumped based on a lot of people talking about tariffs, a lot higher than usual. And as you can see, that hasn't happened in quite some time, and mostly since we had that high inflation post the pandemic. And it's both a 1-year inflation expectation on the left that's jumped, but also the longer term inflation expectations on the right. But that's, again, it's a survey, so it's not necessarily a market value. And as I was saying, a long-term measurement and an inflation expectations is this blue line, that 5-year, and that blue line hasn't really done anything. So while the Fed's going to be looking at this as possible risk, it still hasn't translated in the markets as so far. And I'll pause there because I think, yeah, that's all I really had on inflation per se. So if there are any questions, let me know. Wendy, are you?
No, just an aside. I heard somebody referencing the UMich, it's only serving 900 people. And then they keep saying it's partisan. Maybe can we go back to that 5-year thing?
Sure. This one.
So, yes. So the 5-year. So where do they get these data for the 5-year? It's more prevalent. I mean, it's more, I mean, encompasses more sample size compared to
Well,
that. I mean, they all,
this is
I don't know.
it's not this one's not a survey. This is a trade. So you know how you got Treasury inflation protected securities or TIPS that
Yes.
trade? Well, you've got a 10-year that trades and you've got a 5-year that trades. So you basically use those two to determine what the inflation expectation is from 5 to 10 years, which is what this 5-year is.
Oh, so it's a difference between the 10-year tips and the 5-year tips then.
Pretty much, yes.
Oh, okay, thanks. So yeah, so this is I mean,
This is a
there's
market.
real
It's a market.
money,
Yeah,
yeah,
there's money behind it.
versus the UMich people survey. Thank you.
Exactly. This
Uh,
this would be equivalent to a long-term inflation expectation.
can I belabor the topic because you mentioned that,
Sure.
oh, if the inflation goes up, then the Fed would have to hike rates. But I mean, I hear, of course, people say things all over the place. But I mean, if they hike, wouldn't they worry more about the employment? So they would probably stomach, I mean, the dual mandate for unemployment over high
So
inflation.
I'll show you employment, and so far the sort of the headline is that employment's not too much of a worry, and so they in their dual mandate employment they've ticked the box, and so they would be betting on inflation. Basically, they would be managing inflation, but and that might change, of course, but as of right now, employment's not a concern.
Okay, thank you.
I think we're basically close to an all-time low on unemployment.
But the rate certainly is. So thanks.
Yeah. So the part of what's to be noted is that even though tariffs had increased, what the market did on rates is probably something that Trump wants and doesn't mind. So he's not reversing it so far because if you look at it, he took office call it roughly around here, and the rates had been going up. So this is the 2-year was at about 4.4. Now we're at 3.7, 3.8. And then the 10-year was around, call it 475, and now it's down to around 4.2. So this basically has been mostly affected by the fact that people's expectations is that these tariffs have been tanking the economy and not creating inflation. So the market has reacted to that by lowering rates, generally speaking, with the understanding that the tariffs are a detriment to GDP and therefore have a lower economic activity. So right now, in terms of the actual financial markets, in terms of the bond and rates market, they haven't been worried about it in terms of runaway inflation either. They're basically still saying we're not going to increase financing costs in the United States.
Can I interrupt?
Sure.
You showed the substantial decrease in the 10-year, but I thought the mortgage rates are tied to the 10-year. And I mean, I didn't look too carefully, but certainly I don't believe the swing is proportionate to the decrease in the 10-year. Is that correct?
Let's look it up. I didn't check the uh, I didn't check what the 30-year mortgage rate is, but let's do it. Okay, let me see. Okay, I'm bringing it up. Apologies.
Thank you.
Give me give me a few seconds. Yeah, so the mortgage rate doesn't really seem to have been affected. Let me share my screen now. I need to go find the Zoom. There you go. So this is the 30-year mortgage rate, which is the benchmark. And as you can probably see, it hasn't really been that affected by all the talk, at least as of April 3rd. We're at 664. And that's the scale down there.
Okay.
So mortgage rates haven't really been affected either.
So the 10-year going down, it's because of, I mean, they expect a growth. So that's why it pulled down the 10-year. And then it's I mean, because Inflation seems steady. So the reason for the 10-year moving down is
Mostly the tariffs. I think most people were worried about the tariffs. That's
okay.
what drove that. So if you want to see what you're talking about, I guess, is the mortgage spread, and I was just gonna put that in there um, to show you what the mortgage spread is. It probably means the mortgage spread is increased a bit. Yeah, uh, very ever so. We call it from Jan, ever so slightly. Not anything to write home about. Does that
And
answer your
this is
question,
not,
Owen?
yes, so this is not the usual case. That's right. Or I don't know, from what I
This is the
understand about
30-year
the
fixed rate mortgage minus the 10-year, and oftentimes those are those two are fairly linked. So that's roughly the
yes,
mortgage spread. So
uh-huh.
this has affected. So all we're seeing here is that the mortgage spreads have been moving
Mm.
roughly in line with the 10-year. Not exactly, but pretty close. And maybe I should change this so it's a little bit more there. That's over a 1-year basis. So let's call it Trump took office what around here? Call it Jan 9th-ish. So it's moved, the spread has moved up a bit, but not quite that much. Call it 10 basis points.
Okay, thank you.
Where are we at? What do you guys, can you guys see the screen again?
That's
And
fine.
yeah, okay.
Yes.
So we talked about inflation. We saw how it affected rates. Now the labor market. So what's plotted here are three different measures of the labor market. The blue line being change in non-farm payrolls, the orange one, the change in unemployment, and then the green one is the change in initial claims of the 4-week moving average. Typically, if you can see before recessions, these things start trending down. Definitely during the pandemic. So this is the dot-com bust as it trended down. The financial crisis, and then here you have COVID. They typically tend to trend down at the same time as the recession is happening. So they're not a leading indicator, but they tend to be a coincident indicator, as it's called. You saw that start trailing off as we hiked rates, at least for the non-farm payrolls. The labor market started to get a little bit of weakness. That weakness is still present there, but has been trending back up. So you can see that the zero line is here, and then that's gone down a bit. So we're still it's a little bit weak in that sense, but the unemployment rate hasn't been too much affected. It's been trending down a bit, and the initial jobless claims has been trending down a bit. So there's some effect here, but it's not huge. The point being is that the labor markets haven't been affected, but not really anything to write home about at this point.
This is Rao. I'm a novice in this one. This is the first time I'm attending.
Sure.
If the data shows that the recession may not happen,
The data is never going to show what's going to happen. What it's showing right now is that we're not there's always the possibility of a recession. There's some indicators that have show that usually that happen before a recession happens. The inversion of the yield curve. What hasn't happened is the credit spreads, the credit market's still fine, and the labor market is on the weaker side, but not recessionary. Does that answer your question?
yeah, thank you.
Okay.
But the financial market certainly is flirting with
It's scared.
I mean, so yep.
This is just another measure that you could typically look at. It's investment, and these elements tend to trend negatively before at least one of them, if not all of them, tends to trend negatively before a recession. And it's the personal consumption and expenditures, but of durable goods. That's the black line. The private residential fixed investment, that's basically housing, investment in housing. And then the blue line is manufacturing, so industrial production and basically manufacturing. Again, there's nothing there was that little sign that residential investment was dropping off as rates were getting hiked. It was around what end of 2022, beginning of 23, and right now it's not showing anything substantial at this point. So that brings us then to talk about the equity markets and what's going on in the equity market. So what we're saying is that labor market's weak. So I'll go back and I'll make the summary. We have the yield curve that's inverted. It disinverted and now it's looking like it's reinverting. The credit market hasn't been affected so far by all the qualms that we've had so far, or the inversion of the yield curve. The inflation expectations aren't too worrisome. A hike is more likely than a cut at this point, given the inflation is above target. Tariffs are of a decent amount of concern because as they're hiking, that has an impact on inflation, one, and potentially reducing GDP, two. It's affected, and then but however, the 10-year, both of those have been lowered, so it's doing basically the bond market has eased a little bit. So that points to the Fed probably needing to hike more than to cut as well at this point, because that's easing of the rates market. Labor market is on the weaker side, but nothing that looks 100% recessionary at this point. General investment, not really saying anything currently. Yet we've got the equity markets that have sold off quite substantially. So as you can see, we're down about, I think it's 18% roughly. It's basically a correction at this point. Doesn't look like it's a recessionary sell-off, at least from this perspective. The gaps are quite substantial. So the gaps that we've had over the past couple of days, we haven't had since the pandemic, basically the sell-off during the pandemic.
Can I interrupt? I
Sure.
hate to be contrary, but
No,
let's
go
talk
ahead.
about I mean, who am I? I just reported what I see it. So, but I understand that we're seeing, inflation is above target, so it's likely to hike. But I thought that the market has priced in, I don't know, 3 rate cuts, 5 rate cuts, 6 rate cuts, whatever. But I thought that right now, at least, they have priced in rate cuts for 2025,
They have,
according to
yeah.
that CME.
No.
So
Actually, let's see.
how do you
Have you looked?
how do I make the two things copacetic?
Let's check. Good point. Let's look at the CME Fed Watch. That's the one that you're referencing, Wendy, right?
Yes, because I thought I heard that they said, oh, I mean, it's all over the place. How many, whatever rate cuts, but at least the market has penciled in more rate cuts in the past few days.
It has. So can you see my screen or not?
Yes.
So over the past few days, I don't know, but currently the path is for rate cuts.
Yes.
Here.
So how do I? I mean,
so the market what it has been is the market has been more in the camp of cutting than it has been of hiking, but the Fed at this point isn't really there. And the dot plot, this would be the last dot plot. So the dot plot, see how that's the Fed rates, and the market, at least for 2025, is a lot lower than what the Fed estimates it should be at here, and even for 2026.
Okay. So that's how there's a divergence between these two.
The diversion is the market is more bearish than the Fed is currently.
Thanks.
Daniel, may I ask a question?
Sure. Sorry, who is it?
I think your analysis is spot on up to last Wednesday.
Okay.
But if employment begins to fall off because we don't produce, and if GDP falls off because we're not able to sell our products,
in a world market, and inflation picks up because the cost of goods becomes more expensive, either due to the tariffs or the availability. How is your model? Can you give me confidence? I'm not asking you to give me projections, but can you give me confidence that your modeling is consistent with what's happened over the last?
I'm not doing any modeling. I'm just sort of walking you through different charts and trying to give you the data.
Right, I
The
understand.
last March non-farm payrolls, which is the main indicator of the labor markets, was positive 228,000. Roughly, it's estimated that in order to compensate, just the run rate for a non-recessionary economy is 150,000. So this is above a recessionary economy. So it's basically it's added a lot of jobs, relatively speaking. That's as of March. Now, of course, I don't know what effect the tariffs might have over the long term. I don't know if Trump will keep those tariffs and he won't negotiate something before. So I think there's a lot of uncertainty. And it's very hard to say, okay, all these tariffs are going to translate right away into job losses.
Okay, I just see the events of last week creating a great degree of uncertainty, which I don't understand.
So
And
this uncertainty, I agree with you, but it's a known thing that people often like to trade their politics. I just try to trade the news and not the politics. So far, the data says that the non-farm payrolls, at least as of March, are positive. So the labor market hasn't been affected. Now, if he weren't to enact all those tariffs and they were to stick, that probably would be problematic. I agree with you, but
Is it possible this data may be, lagging behind what the changes
oh,
are
it's
happening?
it's definitely it's definitely lagging since we get it in April for the last month, but and there can be revisions ex post, but so far it's not showing. I mean, Trump has been in office and he's been talking about tariffs for the past 3 months, right? Um, so far it doesn't seem to have had a negative effect. The
Can
other
I
one
just mention something here?
sure.
So, so the Federal Reserve has a dual mandate to, and you can say it better than I can, Daniel, but to bring inflation down and to support the economy
Hmm.
at the same time, and to restrain unemployment from going up. But Trump has Trump has brought in a new priority, which is new, which is to bring manufacturing back to this country and resource here, in-source, whatever they call it, manufacturing and rectify decades of are being ripped off basically by most of the other countries in the world. So the question is for him, which is his top priority? Because he can't maybe have all three. He can't maybe bring inflation down and also, keep unemployment from going too high, and also bring manufacturing back. So he sort of has to choose among those three, or some combination of those three, like a pie chart. And right now, he seems to be favoring, tariffs, which is all about bringing manufacturing back and maybe bringing in tariff revenue. So, I mean, this is a new recipe, and it could be that for a while anyway, it's going to be bringing manufacturing back into this country, and the other two priorities, the Fed mandate, the dual mandate, become secondary, or second and third.
Well, there's two different things. There's Trump and then there's the Fed. They're independent, and I still think Powell would be fairly independent from Trump. I
Yes,
think
I'm aware. I'm totally aware they're independent, but
right.
Trump is dominating right now.
At least in the headlines, he's dominating. But right, if I'm Trump and I'm enacting policy and I'm seeing my financing costs are going down, I don't see it as a problem right now, anything that I'm doing. Because that's going to be my guess is his main market. The main thing he's going to look at, the stock market's one of the things he's going to look at, but he figures like if it tanks in the short term, I'm probably not too worried. But if his financing costs go up, that is a more longer term effect on the way you enact policy and it would go up most likely if inflation expectations or inflation went up. And right now he doesn't have that signal that's giving him any feedback. So I don't think he's going to lay off as of yet on the tariff side. That would be my guess. But I
Well,
mean, I don't know
that's,
how Trump's thinking.
that was my point.
Yeah.
I think he's going to stay with the tariffs.
Yeah.
That's his highest priority, and let everything else shake out for a while.
And there's on the rate side, he doesn't have anything to worry about. And Trump being a real estate guy, I think he thinks more about rates than he does about the stock market, at least from a personal perspective.
Okay, thank you.
And he's mentioned he's also mentioned a few times that he wants what's it called, Powell to reduce rates. And if he can strong arm Powell into reducing rates, it's a win-win for him. I think we touched that. And okay, so this is just a measure of the sell-off in the equity markets. This is on an international basis. I think the main takeaway is like what's happened to the S&P 500 has pretty much happened to the whole world, because this is the S&P 500, this is the AAII, which is the world index. So there's not really too many places to hide. To put in perspective, so this is the volatility index. So how volatile it's getting, to sort of to the point we were making previously, is like it's created a lot of uncertainty, but it's still not anything crazy, at least not anything near what we hit in COVID. And COVID was pretty high. We're getting to pretty high levels, but nothing that's, again, still lower half of what we were at during the COVID pandemic. Then the other things, sort of, I was trying to, correlate with other markets and see what's going on. Crude typically tends to be potentially, sell off if GDP is not doing well. So crude has been going lower. So that's an indication that, there's maybe lower demand on crude oil, since it's basically broken sort of that 2-3 year bottom recently. So that's more of a negative effect on GDP. And gold has been trending upwards. And that's probably to say that there's been a decent amount of inflation over the past few years. There's a loss in confidence in potentially the dollar with the tariffs goes up, and if there's maybe some easing going on. So gold has been trending quite a bit higher. I think that was it in terms of what I wanted to, prepared remarks.